Hello, and welcome to the Wealth Management Invest podcast. I'm your host, David Bodamer, part of the editorial team at wealthmanagement.com. In this week's episode, I'm excited to have with me Doug Huber, who is Vice President of Investment Strategy at Wealth Enhancement Group. Hi, Doug. Welcome to the program.
Hey, David, thanks so much for having me.
So, before we get into some discussion of portfolio strategy and the use of alts, I was wondering if you just wanted to take a minute to talk about who Wealth Enhancement Group is and, maybe a little bit about your experience.
Yeah, sure thing. So Wealth Enhancement Group is a national RIA. We have, I think, over 100 offices around the country now. We manage in excess of $80 billion for our clients. Our growth strategy has been some mix of RIA acquisitions and organic growth to get us to where we are today. And within Wealth Management or Wealth Enhancement Group, I am the Vice President of Investment Strategy, where I lead our investment teams focused on manager due diligence, asset allocation, equities, fixed income, alternatives, and kind of all of the above. My background is I spent the last 17 years doing investment research, manager due diligence, and asset allocation, and a good portion of that was spent allocating to alternatives.
And so, can you talk a bit about who Wealth Enhancement Group's clients are?
Certainly, yeah. So I think today we serve, probably over 75,000 clients, and so it's a very diverse mix of clients, anywhere from kind of a mass affluent client all the way up to the ultra high net worth individual or family.
And so then how does using alternatives fit with that client base?
Yeah, absolutely. And it's a great question. I think if you asked me this a decade ago, obviously, our alternatives solution set would only be tailored to our ultra high net worth individuals. Mm-hmm. And there's certainly a big focus of that. But with this trend of democratization of alternatives, which I'm sure we'll get into, there is solution sets where we can bring that advice to a smaller client size. So we can bring that down to clients with a accredited status versus qualified purchasers. And in some cases, there's even solutions out there for clients who don't even meet that accreditation status. And so we want our advice to be the best out there. We start with that, but if we can find solution sets where we can deliver that advice to a broad swath of clients, that's the best of both worlds.
And would you say that, we heard a lot of buzz about, you mentioned it, democratization, or just the idea in general that there's more interest in alts, even lower down into the mass affluent or accredited investor, not just qualified purchaser. What do you think is driving that conversation right now?
Yeah, that's a great question. I think there's a few trends at play. I mean, first of all, the opportunity set of available investment options has certainly grown. I think what was a decade ago kind of a few asset managers dipping their toe into the water, likely they didn't want to cannibalize their institutional business. I think the early products that were made available weren't always in the best alignment with kind of what they were doing at their higher end. I think fast forward, a lot of these asset managers view the wealth management channel as a big area of growth. It's an untapped potential, whereas a lot of the institutional money, asset managers know where that is. Sometimes, they're just kind of shuffling the deck chairs, moving from one manager to another. This is an entirely new pool of capital for them to go after. And I think with that, they've realized not only has the RIA channel gotten a lot smarter at this, and in a lot of cases, has that kind of institutional quality due diligence that they conduct. And so the product set has not only increased in breadth, but also in quality. So we have a lot more, we have a bigger pond to fish in, and there's a lot better fish in it. And then from there, I think, frankly, I think a lot of families and individuals have hear about these. It's talked about a lot more in mainstream media. And they go to their advisors and say, hey, what are alternatives? Why don't I have them in my portfolio? And I think it's an interesting dynamic between kind of supply and demand of a push-pull, a little bit coming from the client, and also a lot more out there to service them.
And the goals probably differ, but are there some primary things that people are looking for in using alts? Is it just diversification? Are they looking for return? What are the use cases for alts for different investors?
Yeah, I think there's probably a variety of responses to that. I'd say the way we think about it, we look at our investments from kind of a sub asset class, but when we think about building portfolios, we build them for the objective of the client, as you mentioned. And we think about it in three broad strokes. We have return enhancement, we have income generation, we have diversification, and then there's a world in which a client might want all three of those things and you roll them all into a big portfolio. But that is how we kind of think about it. I would say what we see is relatively even adoption kind of across those objectives. I'd say maybe a little heavier towards return enhancement and income generation, with diversification kind of being, maybe the third in line. But I think, even those first two objectives can also, accomplish some diversification. And so, I think there's a lot of overlap, but I do think we see it just depends on the client and what they're trying to get out of kind of in a liquidity premium, these investments that are a little bit more esoteric. What do you want? What role do they serve around your traditional fixed income and equities?
And is interest kind of across the board demographically, or are you kind of seeing it more from younger or older clients?
Oh, that's interesting. I think it's pretty broad based. I would say what clients are interested might be a little bit different, dependent upon what their demographics are, right? I do think maybe younger clients with a longer investment horizon, they probably are a little bit more interested in things that are more return generative, right? They're
Right.
trying to enhance their return. Maybe a more older clientele is more interested in either diversifying their risks or looking for a little bit of additional income to kind of support their lifestyle. They're kind of through their wealth accumulation stage and generally prefer less risky strategies that have a little bit more of a high probability of generating income for them and letting them kind of live out their lifestyle as they've been accustomed to.
So I think a big theme that folks talk about here in terms of just getting started is education. Just because when we're talking, we're kind of using alternatives as like a catch-all term, but we're talking about a number of different asset types and a number of different wrappers that you can
Sure.
be delivering that to your clients. So what is your approach to education, both internally around the advisors at Wealth Enhancement Group and externally to your clients?
Yeah, you're absolutely right. We have found since launching our alternatives platform that the education component is paramount. And there's a variety of reasons for that. Even advisors that are very accomplished and have worked in these spaces before, there's still an ongoing education component. There's working with them to learn how to build these portfolios, to even think about how additional uses of alternatives, can help their clients and their businesses. There's also some advisors that this is new territory for, and we need to make sure that they feel comfortable, that they're conversant in these subsectors that you mentioned, so that they can deliver advice to clients and also feel that they have a good handle on what they are recommending to that client. And so we've approached it in a few ways. We're really excited. We have a big 5-part seminar that we're putting on for our advisors coming up in June and July. We've got it CE certified, so they can get their continuing ed credits. So we're very proud of kind of putting that together. And I think from that, a lot of advisors they'll get a lot of takeaways, about these underlying sub asset classes. So we're breaking it down into kind of a private equity 101, alternative lending 101, real estate, real assets, infrastructure 101, and kind of a hedge fund 101. So I think, from that, we're trying to equip the advisors, not only for themselves, but also to take this information and be able to bring that to the clients. I think as our client base grows in terms of who's using alternatives, I think we do have some ideas as we look forward to the future about doing some more client events. With those that are already allocating, we oftentimes will bring some of our kind of recommended allocations, recommended investment managers, do small kind of, lunch and learns in certain regions, a couple groups of advisors, they bring a few clients, we bring in a manager, and that's been really well received. It's also really, it's a good tool for prospecting as well. I think there's a lot of folks out there that are really interested in learning more and hearing kind of from the horse's mouth. And we've had some good success with that. And I think we're thinking about, how can we parlay that in an even bigger way?
Yeah, and it seems like it'd also be a kind of dynamic conversation, because it seems like almost every week I'm getting releases of a new fund that's being launched, or something that's like, there's a new interval fund, there's a new BDC. It's doing maybe a slightly different strategy than what's out there. So it's kind of an evolving field. So even like if you've done some of the education, you might have to revisit it in 6 months, just because like the landscape is moving pretty rapidly.
Yeah, I mean, you're absolutely right. I mean, my email inbox is certainly a pretty good barometer of kind of the where the new launches are coming from. And you're absolutely right. We see a lot in the private REIT space. We see a lot
Mhm.
in BDCs. Infrastructure is big right now, and
Yeah.
so it is evolving quickly. And I think while it's been a positive in my mind of this idea of these new product launches. Some of these things have semi-liquid structures. They're a little bit more attractive in terms of minimums and potential for liquidity and tax reporting and other things that are certainly appealing to a broader range of clients. There is a flip side of that coin that a lot of due diligence needs to be done on these. And I think kind of steering this a little bit, I do think it's important for us too to kind of always stay on top of these trends, because
Yeah.
it's not just as simple as saying, hey, great, there's a new product, let's go invest in it. It takes months and months of digging under the hood to really make sure that we feel that we have a great understanding of not only the team and their process, but also the product itself. Valuations, liquidity, other things that we want to make sure that we are setting the right precedent, that when we do deliver this to an advisor who will ultimately deliver it to a client, our expectations are very clear and aligned, and we are setting those, up right out front, so you know what you're getting into.
Yeah, that was actually going to be my next question, which is, get into a little bit of the meat of that due diligence process. But you've already anticipated that and started to explain that. But along that front, do you see some evolution, as the asset managers, as they increasingly try to target that space, in evolving how they are approaching you and tweaking, what they need to do on a reporting standard or a transparency standard, or any number of fronts? Like, what does that kind of interplay look like when you're vetting these asset managers and doing the due diligence, and these things are evolving?
Yeah, I can speak to what I know, but I'll admit that our relationship with these asset managers has kind of always, has been there. We have a long history
Mm-hmm.
working and networking in the space. And so our diligence process is coming from more of an institutional place to begin with. So our interactions haven't adjusted all that much. We've
Uh,
always demanded levels of transparency. We've always gone very deep on the operations side, because there's a lot of important things you need to evaluate there. What I would say is you can see that, yes, I think the transparency is certainly improving. The cadence in which they're communicating is certainly improving. I think they are keenly aware of the subject we just talked about, and that the education component is huge. And
right.
so we see a lot of these asset managers bringing on teams, to just be focused on kind of educating, not only on the product that they have, but I think they're being smart and taking a step back and realizing it's not just about, the product pitch. It's really about getting these end users very familiar with what is private equity, what is
Mm-hmm.
direct lending, things like that. And so we do see a real big push from them on the education component. And I do think because people are wading into these registered products, so to speak, there is increasing transparency vis-a-vis what you would have traditionally expected in, a more institutional long lock product.
Yeah, there's definitely a big proliferation of kind of alts 101 sections on asset manager
Yeah,
websites.
absolutely.
um, in terms of like some of the more traditional, like the stuff that, we've been talking a bit about kind of some of this newer stuff that's got the lower minimums and the 1031 reporting and that kind of, not 1031, 1099 reporting. But in terms of some of the more traditional, you do work with some of the, you still work with some of those longer term drawdown vehicles as well, correct?
Yeah, absolutely. I think we approach any investment that we're trying to get into a portfolio. If we're trying to fill some blank space that we think we have in our alternatives platform, we really start at the top, and we would be, we want to maintain or be product agnostic to the best of our ability out of the gate. So we really want to identify the best option out there, and then we'll evaluate, how is that being delivered to us. Sometimes we need to find, a secondary solution if it's only available in kind of a QP product, 10 or 12-year life private equity fund. Sometimes we do, need second solutions to make sure we can bring that advice down. So yes, we span the gamut in terms of product type. We don't really have a preference, but we definitely want to make sure that whatever product type that is, it fits the investment we're trying to make. We're not trying to fit a square peg in a round hole.
And in doing some of those vehicles, how do you structure that? Do you have like a feeder fund that your clients can go into for some of these, or do you put them directly into those investments? How does that actually work?
Yeah, absolutely. To date, we have not established a feeder vehicle for our clients. It has not been an issue. I think we've had some really good longstanding relationships with some of these asset managers that are really looking forward to partnering with us. And so they've been very flexible in terms of letting our clients go direct into their fund. They've been very flexible in lowering minimums for us from, as high as 10 million all the way down to 250,000. So we work with them very closely to make sure that we can get a product that is going to fit for our client base. And in some instances, it doesn't work. And I totally get that. But so far, if we've had asks, we've had really good responses from the asset manager side. So yeah, sorry, I apologize. I lost my train of thought there.
That's okay. We can probably just cut it off right before you said that.
Yeah.
Maybe, yeah, Wendy, if you can note that.
Sure.
And so in terms of the overall like alts landscape, are there particular asset types that are, that you're more focused on than others for 2024? Like, is it, I hear a lot about private credit, like you mentioned, a lot about infrastructure. Within the alts, the broader alts universe, are there hotspots right now?
Yeah, I think there's a lot of hot spots in the market. I would say, we don't try to be super tactical in our alternatives allocation, right? I think we're really thinking about these for the long duration assets they are. I would say for us, our focus really has more to do with our platform and what we're trying to build. It is a relatively new platform. It's been up and running for just about a year in its current construct. And so we're still trying, we've laid a good foundation, but we're still constructing the house a little bit. And so, there is blank spots that we have that we know we need to fill. So our focus is more on continuing kind of the build out of the platform as opposed to, saying, hey, we think this is a great area today. That being said, we certainly think about the dynamics in the market a lot. Private credit is a hot button issue. We've certainly seen a lot of that launched. It's certainly demanding more market share in terms of lending into the capital markets. And so there's a lot of interesting things there too, but I think there's a lot of risks. I'm certainly not in the camp that there's some huge bubble, but I do think you need to be thoughtful about where you're placing your bets there, right? These are highly levered corporate capital structures. It is the equivalent of kind of high yield or bank loans in the public market. And so in other words, this is still what we'd call quote unquote kind of junk credit. And just because it's wrapped in a semi-liquid or illiquid wrapper with less volatility doesn't mean those risks aren't there. And so we think a lot about that. But I do think there's a ton of opportunity too. I think you really need to pick your spots here. And I think if we look at our alternatives platform as a whole, we don't try to really quote unquote index any of our exposure. We really want targeted active managers that are delivering on something that we think is kind of is repeatable, number one, but is a certain seam in the market that we're trying to extract that return premium from. For us, for the rest of this year, I do think we'll be bringing on a couple more what I'll call alternative lending strategies as we think about that portion of our portfolio. We don't want it to be exclusively kind of private corporate credit. We want some of that for sure, and we have a couple solutions today. We'll likely maybe add one or two more, but we also like other areas. We want to think about kind of diversifying our collateral, so to speak. So we do like asset-backed finance a lot. We think that's a really interesting part of the market where we've seen what used to be dominated by a lot of regional banking players is now, as they stepped away, there's a lot of gap in that market. And I think some of these asset managers are well positioned to take advantage of that. And being asset backed, it is a little bit different than being kind of cash flow backed. We're exploring the real estate debt market. Obviously a lot has been said about real estate and there's a lot of interesting dynamics underlying that. So that's not necessarily a distressed play, but I do think there is opportunity arising there. Again, there's a kind of, as regional banks step away, there's a little seam opening up as well. So we like to look for pockets where we think being a liquidity provider is a net yield to us. We're always looking to add thoughtfully on our private equity allocations. We do find clients get that. We tend to prefer kind of real operators in the space, the roll up the sleeves, buy a company, make some adjustments, grow that company, and then kind of sell it on to the next buyer, and whether that's strategic or financial, as opposed to, there's other ways to create value. Some of it can be financial engineering and some other things. We tend to lean more to that smaller, lower middle market private equity player. So we'll continue to add there. And then in real estate too, I think we're looking around for opportunities. We could certainly be additive in kind of a more value add approach. That's something that our platform, we don't have at the moment, and we're kicking that around as well. So for us, we're pretty broad based in what we're looking for going forward. Again, not really trying to play any particular theme. I would say if there's one thing we think is what I would call opportunistic here, is there could be potential for some dislocation in some of the legacy private corporate credit, the legacy direct lending from the last 3-4 years. We've seen a little bit of stress show itself, and it's been talked about a lot, but a lot of the paper that was written post-COVID, as there was a lot of demand out there. A lot of it was written what they call covenant light, so the protections weren't necessarily as strong as they've been in prior cycles. And I think there's some players out there that are looking at that saying, there's going to be stresses and we can step in an interesting way. So something in that kind of opportunistic credit space would maybe be a play that's a little bit more timely, so to speak. But like I said, on the whole, we're pretty long-term and strategic in our kind of asset allocation as it relates to alts.
And for your clients that are using alts, is there like an average part of their portfolio that's allocated here? Do you have recommendations? I'm sure, with the caveat that absolutely for every client it's going to be individual decision, but beyond that, are there kind of broader, are there some averages that you see in terms of like overall I mean, because there's all this talk about, is 60-40 debt or not, or are we doing 50-30-20, are we doing 10? Do you have like any kind of numbers around that?
Yeah, I think, again, a little bit unique to us in that a lot of our clients, this is the first time they're building out this platform and building out their portfolios. A lot of our clients didn't have experiences in alternatives prior to the last 12 or 18 months. And so for them, I don't think any of them are near kind of that target weight yet. So I'll step back and say that we are still in that build out mode. And I would say, when building these alternatives portfolios and programs for clients, it's really important to stage those investments in a thoughtful manner, and not just say, hey, if client ABC needs $1 million of exposure, we're going to put it to work today, right?
Mm-hmm.
We'd like to kind of steadily allocate that over 2 to 3 years for a variety of reasons, whether that's vintage diversification, whether that's just to give us a little time to let the portfolio start to mature and start to cash flow. Ultimately, you'd love to have these things self-funding at some point in time. And so our clients, I don't think, any of them are kind of at their long-term target weight to date. We do provide recommendations. I mean, if you look out there, a lot of institutional investors have 50% of their portfolio in these investments. I'm not sure that makes sense for individuals as much. It's obviously would be a large portion of your net worth to be illiquid. So we're thoughtful of that. And you're absolutely right in your commentary that each client's very specific, right? Some clients have, less liquidity needs, and as such can take on some additional liquidity. Some have much greater liquidity needs, and we need to be thoughtful of that. We generally provide some guidance around building a portfolio out at, the 5% level, the 10% level, and the 20% level. Those are kind of where we'll guide to, but that's usually just a roadmap and a discussion point. And from there, we then try to tailor that advice with the advisor for each individual client, because like you noted, everybody's very different, and we want to make sure the solution fits for each circumstance.
Well, Doug, I've taken a good chunk of your time here, so I want to thank you for walking us through all this. I just wanted to give you an opportunity, if there are any final thoughts you have, or anything that I didn't ask about that you thought would be good takeaways for the audience, just to give you a chance to say that.
No, I think we covered a lot here. I think, it's this topic is very timely, and I think it will continue to be timely. I think we're just at the tip of the iceberg here. I was reading, there's some articles out there, just how much, how many dollars have flowed from kind of the retail or high net worth channel into alternatives and what they think the ultimate market segment could look like. And it seems like there's still a long way to run here. And I would anticipate that many of the asset managers see this, and I think we'll continue to see folks very focused on the wealth channel going forward. The thing I would add is simply that, a lot of these have very good stories and very talented teams behind them, but, not everything is face value. And these products really do need a lot of diligence to make sure you are getting exactly what you think you're getting. And that, these still, despite some of them having semi liquidity on the cover, we know that that's not always the case, and that sometimes everybody might try to run for the door at the same time, and you get locked up. I don't think that's a problem with the structures. In fact, I think it's a protection in the structure to some degree, but you want to be cognizant of that. So other than that, I really appreciate you having me on. Thanks for taking the time to chat with me. This was great.
All right. Thanks again. So, and if folks want to find you, what's the best way to look for you?
Yeah, so you can find me on the Wealth Enhancement Group website. You can also email me or reach out to me on LinkedIn. Any of the above is where you track me down.
Okay. And for folks, who aren't aware also, we have ongoing investment coverage at wealthmanagement.com. So make sure you check that out. Also, that's where you can find past episodes of this podcast.
All right. Thank you, David. And thank you, Doug. And thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.